Hello, everybody. At this time, we are talking about a portfolio. As per portfolio definition, it is a collection of a wide range of assets that are owned by investors. The said collection of financial assets may also be valuables ranging from gold, stocks, funds, derivatives, property, cash equivalents, bonds, etc. Individuals put their money in such assets to generate revenue while ensuring that the original equity of the asset or capital does not erode. Depending on one's know-how of the investment market, individuals may either manage their portfolio or seek the assistance of professional financial advisors for the same. As per financial experts, diversification is a vital concept in portfolio management. And then we move to components of a portfolio. The first, equities. These investments provide ownership of companies and potential appreciation in capital. Stocks are classified as large cap, mid cap, and small cap depending on the size of the company in terms of market value. Second, commodities. Real assets like oil, silver, gold, and foodstuff act as inflation shields and portfolio diversifiers. They appreciate in price regardless of bonds and stocks, thus reducing risk as a whole. Third, fixed income. Bonds provide regular interest income and are generally safer than stocks. They include government bonds, corporate bonds, and municipal bonds, each with varying risk and return profiles. And then fourth, real estate. Real estate investment can provide rental income and appreciate in value over a period of time. Real estate investment trusts provide an indirect way of investing in the property market without physically holding the property. And then fifth, cash and cash equivalents. Liquid funds such as savings accounts, treasury bills, and money market funds fall under this class. They give quick access, especially access to cash while retaining capital. 6. Alternative investment. These include hedge funds, private equity, and other assets like artwork or vintage cars. And then, how to create a business portfolio. The first step, choose a format or portfolio tool. Depending on the and complexity of the organization, creating an organized and thorough company portfolio can be complex. Consider looking for company portfolio templates to help you begin the process and determine which information to include in the portfolio. There are also many programs and company portfolio tools you can use to input information and share the portfolio with others within the organization. Second, refine the mission statement and objectives. If the organization doesn't currently have a clear mission statement or company objective, it is a good idea to communicate with other business leaders to create one. Being clear about the company's purpose within the portfolio can help provide context for projects. And if the company has a mission statement and a list of objectives, consider refining them before listing them in the portfolio. And then third, list affiliations and business relationships. The portfolio is a good place to organize and specify affiliations and business relationships. A business affiliation is a relationship in which one company owns less than a majority of another business stock. Business relations are connections between professional entities, which may include the business relationships with vendors, suppliers, and certifying organizations, and include information about these relationships in the portfolio. And then fourth, regularly review the portfolio. After compiling and organizing information within the company portfolio, you can implement a system for reviewing the information. For example, the company's mission, products, and relationships may change often you create the portfolio. Consider reviewing and updating the company portfolio each quarter or semi-annually to ensure it contains accurate information. And then we move to strategies in portfolio management. There are various strategies that can be applied in portfolio management depending on the goals and risk tolerances of the organization or investor. Some common strategies include the first, active portfolio management. This involves making continuous decisions to adjust the composition of the portfolio based on market conditions and individuals' goals. This can be achieved by buying and selling securities, reallocating assets, and using derivatives. And then second, value-oriented portfolio management. This strategy focuses on re-electing undervalued investments that are expected to generate above average return over the long term. This can be achieved through fundamental analytics, technical analysis, or both. And then third, positive portfolio management. With this strategy, the composition of the portfolio is kept relatively constant over time, focusing on long-term growth and risk diversification. Passive management can be achieved by investing in index funds or exchange-traded funds. And then fourth, growth-oriented portfolio management. This strategy focuses on investing in companies or projects with high growth potential. This can be achieved by identifying market trends, industries' growth, and innovative technologies. And then we move to things to consider before building a portfolio. The first, about time horizon. Time horizon is the number of years or months the investor will invest to achieve their objective. It means that investors must modify their portfolios based on their objectives. Also, different time horizons entail different risk tolerance levels. And then second, risk tolerance. Risk tolerance refers to an investor's ability to lose a given amount of their capital in anticipation of higher future returns. For instance, investors with high risk tolerance levels are likely to risk most of their investment in high beta stocks, real estate, oil, etc., with an expectation of higher returns. On the contrary, investors with low risk tolerance levels are more inclined towards secured assets like large cap stocks, investment grade bonds, cash equivalent, etc., which can preserve their original investment. I think it is enough. Thanks for watching.